Okay. Good morning, everyone. Uh, Good morning. Today is our last session on Ind AS 115. A lot of concepts to cover. Many concepts we have already covered. So with that, let us do. Today I'll be a little fast because I have a number of concepts to discuss. At the same time, I will be discussing some examples and some of the illustrations. Let us see whether we can get it done from the study material, or I have a couple of other illustrations which I'll be presenting to you for your reference. Okay. So let us start our discussion. So far what we have seen is, we have seen the 5-step model. The 5-step model begins with identifying the contract. Then you identify the performance obligations. Then the third step is determining the transaction price. Fourth step is allocating the transaction price to the performance obligation. And the fifth step is recognizing the revenue as and when the performance obligations are fulfilled. So we have done step numbers 1, step number 2, step number 3 also we have done to a great extent. In step number 3, the last what we were doing was determining the transaction price, and we had discussed financing component, if you remember. In the transaction price, there were multiple topics that we discussed. The first one was variable consideration. Variable consideration, if it is in the variable consideration part, what did we discuss? There could be fixed as well as variable. So the variable consideration is to be included in the transaction price if it is not subjected to constraints. Not subjected to constraint means you are fairly certain that you are going to achieve it. When I say variable consideration, it could mean consideration in the nature of performance linked bonuses, or penalties are also included. Variable consideration subjected to constraint means probably you are not having sufficient experience or exposure in that particular project. Okay. And because of this, there is a significant probability of a reversal of revenue in the future. And because of the significant probability of reversal of revenue in the future, the standard says that if variable consideration is subjected to constraints, you will not be including it in the transaction price. You will not be including it in the transaction price. Okay, so this was what we had already seen in our example. The basic thing is we have to ensure that we are not overly conservative with recognition of revenue. Rather, we are as realistic as possible. So when I talk about variable consideration, we have penalties also in that. So transaction related penalties for not completing projects on time, you will include within the scope of 115. That means if you estimate that probably the project will not get over, then at that point of time, you will include it as the variable consideration. That means the fixed cost, consideration, if it was 1,000 crores and you are having a 30 crore penalty for delay per month, and if you think you will be delayed by 1 month, your consideration will be 970 crores, 1000 minus 30. Okay. Protective penalties are excluded because they are only for safeguarding the position of the seller, not otherwise. Okay. So these are the types of consideration, fixed and variable. How do I estimate the variable consideration? We had discussed you could either follow expected value method, that is the weighted average method of probabilities, or you could follow the most likely method, which is either yes or no. There is no what you can say multiple cases which exist. Okay, so that is how you are going to estimate. It could be either the expected value or the most likely method. Okay, so that was what we had discussed. We saw some of the illustrations. Then we came to warranty offerings. Warranty offerings could be of two types: an assurance based warranty or a warranty sold as a distinct offering. So if you go to a car, the car will come with a 1-year warranty. So you cannot go to showroom A, buy a car and tell him that do not give me the first year warranty. I'll buy the first year warranty from another showroom. That is not possible. The assurance based warranty comes with the sale. It's not unbundled as a distinct offering. So therefore, the car and the assurance linked warranty are always sold together, and therefore for the first year warranty you will make a provision for the warranty cost that you are going to incur on best estimate basis. From years 2 to 3, 3 to 4, 4 to 5, depending on each showroom's discretion, you are having an extended warranty. So that extended warranty is sold as a distinct offering. Sometimes it will be sold along with the car itself. They will say, sir, if you buy the extended warranty right now, you are getting a discount. If you buy after 1 year or later on after the car leaves the showroom, we are going to increase the price, because that is how the market is. So it is now actually a distinct offering in its own right, and that is why you will have to treat it as such. It will be a separate revenue stream for which separate costs will be incurred on accrual basis. Then once this was done, we also saw a sale or return as to when the return is actually, when am I going to recognize the revenue in the case of a sale or return transaction. Okay, so under the ICAI regime, we would normally wait till we got a confirmation from the customer, which Ind AS again says it is highly conservative. As per the standard, revenue is the amount expected to receive from sale of products. So suppose you sold 100 products, you expect at the most 5 products to be returned. You recognize the revenue on 95 products. The remaining is going to be a contract liability, for which you will also reverse the cost of goods sold. That means the cost of goods sold, you will pass the entry inventory account debit to COGS, because this is your inventory which is lying with the customer. So that takes care of the sale or return. There is a separate restocking fee provision. Suppose you are having a sale from sale made to a faraway location based customer, and he decides to return the product for whatever reasons, then the cost of return, the transportation charges will be fairly high. So therefore the contract specifies that the customer is going to pay the restocking fees to the seller. So therefore what would have happened is the customer makes a payment to the seller initially when the goods are delivered, and then when he presses the return option, at that point of time there has to be a refund that will go to the customer. That refund will be net, generally it will be net of the restocking fees. It will be net of the restocking fees. So in the case of restocking fees also, you will book the inventory and you will book the refund liability, and you will also recognize the restocking fee as your income. So this was restocking fees, and we were discussing, as far as I remember, significant financing component. So what is the meaning of significant financing component? If the gap between discharge of obligation and receipt of consideration is more than 12 months, then it is implying that there could be a significant financing component. It's not necessary that it always happens. Okay. For example, if you look at the real estate projects, the very first booking amount that you pay and when you receive the possession could be after 2 to 3 years after you pay the booking amount. So is there a financing component here? No. This is how the industry is progressing. You cannot expect the builder to do the job on his own funds and then transfer the flat to you and you pay the full consideration. If that is the case, then the project costs would be very high and it would entail a huge amount of cash flow for the builder initially, which is not practical. So in such cases, there is no significant financial component, but in all other cases where it is not an industry practice, you could be having a financing component. So when we are having a financing component, there are 2 revenue streams to be recognized. One is the revenue stream from satisfaction of performance obligations, And the other one is your finance income or finance expense stream. Sir, why do you say finance expense? Income to samajh mein aata hai. I sell today and recover the consideration after 2 years, 3 years, whatever. Why finance expense? Because it could be possible that the customer has paid in advance and you are transferring the product after 2 years, 3 years, whatever it is. So therefore, the customer also will say, I'm giving you money in advance, so you have to give me some benefit in the pricing. So usko hum log bolte hain finance expense for the supplier. So in this case, the customer is financing the supplier, so you are going to have a finance cost for the supplier. Okay, and then we were seeing the example illustration 39 in the last class before we actually wound up. So which rate of interest should I normally use was the discussion we were having. If you all recollect, it was the fag end of the session. So which interest rate should we consider? So the standard is very clear. It says that you have to use the incremental borrowing rate. The incremental borrowing rate will be the rate that you have to consider for financing, not the internal rate of return. If incremental borrowing rate is not available, you can go ahead and use the IRR. This is a departure from the interest rates used in Ind AS 116, where the focus is on using incremental rate of internal rate of return, that is IRR, instead of incremental borrowing rate. So basis that we had done the question had given us both the options. If the contractual rate equals the borrowing rate, and if the borrowing rate is different and contractual rate is different. So when the two rates are different, the IBR is different from the IRR, we do the discounting to arrive at the fair value of the performance obligation using the incremental borrowing rate, which in our example, it was 14% and the IRR was 10%. When IRR equals to IBR, then you can just be rest assured that the transaction price is equal to the fair value. If IRR is not equal to the IBR is generally higher than the IRR, then the fair value of the performance obligation will be lower because you are discounting at a higher rate. And that is why you will have a lower price arrived at for the purposes of accounting the performance obligation based revenue, on which the finance charges will be accounted on a periodical basis. Are we clear with this? You are able to understand what all we did till now? Yes? Sure? Anybody has any doubts? I just kind of quickly ran through what we did because last class was a little heavy for all of you. Okay? Anybody has any doubts so far? No doubts. All clear? Okay. Vanshika, Mufita, good morning. Manisha, Leena, Vimal, Viraj, Shailesh, Shankar, good morning. Good morning, Pooja. Good morning. Good morning, Deepak. Yes. All clear, everybody? You could at least revise through what all has been done? Yes? Okay, fine. Now let us proceed further. A small 2 to 3 things are left in step number 3. Step number 4 is very small, so I will rush through step number 4 because the most important part is step number 5 for today's discussion. It is like what all we are doing, step numbers 1 to 4 is like preparing for the Olympic race. Okay, you have done extremely hard work and you have built your skill sets, you have understood all the steps, but the Olympic race is step number 5, that is recognizing the revenue. So if we don't reach that, then there is no point in doing all the 4. So I will complete step number 3, another 1 or 2 things are left. Step number 4 is very simple. I'll give you the theory snapshots of that. And then we move to step number 5 because that is where the actual revenue exists. Okay. Good morning, Yadu. Good morning, Mohammed. Good morning. Okay. All right. So now let us start with the next one, that is a non-cash consideration. Non-cash consideration. Acha, what do you mean by a non-cash consideration? That means basically it is a barter transaction. It is a barter transaction. So when you have a barter transaction, I am performing an obligation, and in return, I am getting something which is not cash based, something which is not cash based. I'm getting an asset probably, or I'm getting another obligation that the customer is performing for me. So customer performing another obligation is covered separately, which we are going to do after this, Okay. Now, this is something which you would have also seen at your end. Okay. Suppose you are buying a mobile phone and you already have an existing cell phone. So what do you go for? You go for an exchange. So what are you giving to the supplier? You are giving cash and you are giving your old mobile phone. So this is partly non-cash and partly cash. So now the question is, how do I recognize the revenue? So the standard is very clear. You are going to recognize the revenue. Based on expected value of consideration to be received. What is the basis for revenue recognition? Revenue shall be recognized as amount expected to be received. That means if I have to say amount expected to be received, then that means you are going to recognize your revenue based on the fair value of the non-cash item that you are receiving. That is fair value of asset received in the case of non-cash consideration. If you refer, when you go ahead, you will study Ind AS 16, Ind AS 38, Ind AS 40. So there also you are having what will be the cost in case of non-cash consideration. There it is written, it will be fair value of asset given up unless the fair value of asset received is more clear or more reliable. So this is what is the term. There it is fair value of asset given up, because there you know what you are giving up. So that is why you are going to take that. Or it will be fair value of the asset received if that is more reliable, reliably measured. Okay. So this is what you are going to look at. There. But in revenue standard, revenue shall be recognized as amount expected to be received. And therefore, we will always do the valuation in the case of non-cash consideration on the basis of the fair value of the assets received. And if you are unable to determine the fair value of assets received, only and only in that case, you can refer to the fair value of assets given up. If fair value of asset received is not available, then fair value of asset given up. This can be considered. But the question of reliability does not arise here. Here it is very clear. First preference to what you are receiving, and the second preference shall go to the asset given up only if the first fair value you are not likely to recognize. Only if the first fair value you are unable to measure. Okay, so that takes care of the first part. Okay, so that is non-cash consideration, fairly simple. Now we come to an interesting concept, that is it okay non-cash consideration? Yes. Anybody has any doubts here? Yes. Non-cash consideration, any doubts, any discussion? Okay, so you can go through these illustrations 48, 49, 50, 51. They are all quite simple, not difficult. Okay, now I will be taking you through the remaining, the next concept, that is payments to customers. Okay. Payments to customers. Acha. Now, let us understand this with the help of an example. Okay. See, ideally, I have a seller, I have a customer. The seller sells goods to the customer, and in return, the customer pays the money to the seller. So here there is goods or services, and in return, when customer sells goods to the seller, there will be payment that will go. But sometimes these transactions will be coupled with something like this. Along with the first leg, the customer also provides something to the seller, and the seller gives a payment to the customer. So here I am having goods or services provided by the customer to the seller, and the payment goes from the seller to the customer. Now, the Accounting Standards Board, which set up this, the IASB, they started viewing this transaction with a lens of suspicion. Why? Because this leg, tell me, the second leg of transaction, do you think this leg is normal or do you think this leg is abnormal? Yes. Do you think this is normal or this is abnormal? What do you think? Sir, ideally seller should do the good services, customer should make the payment. Second transaction to something is fishy about it, right? Something is fishy about it. And that is why this particular clauses were introduced. Now, when I talk about such arrangements, how would it look like? Okay, or what would it look like? So let us understand. Okay. Many of you would have gone to some store like McDonald's or KFC or Pizza Hut or Domino's, one of these outlets. Okay. Now, in one of these outlets, so I have a McDonald's store. Okay. I have a McDonald's store. Okay. Now, when I look at McDonald's store, you would see that there is a beverage machine. Correct? There is a beverage machine. So in the beverage machine, the beverages which are available are either Coke or Sprite or Fanta. Basically, all of them are products of the Coca-Cola company. Okay, all of them are products of the Coca-Cola company. So Coca-Cola company and McDonald's have entered into exclusive agreements with each other, saying that McDonald's will only sell Coca-Cola beverages to its customers. You are aware of this. Okay, so that is fine. Now understand the transaction. The Coca-Cola company comes to McDonald's and says, look, you are providing fast food. Fast food is suited with beverages. I will give you the beverages. You should not be selling others' beverages. I will be providing the beverages to you. Okay, I will be providing beverages to you. Fine, McDonald's says, okay, but I should, and then McDonald's will make a payment also for the beverages. Okay, so this is supply of goods or services, and this is the payment. Okay. McDonald's will say, so you expect me that in the future, if somebody comes, like PepsiCo comes with a better offer, I should not accept it, which is fine. But in return, what do you want? So Coca-Cola says, look, my beverages are best served when they are chilled, all of that. So therefore, you have to put it in a separate machine. You have to ensure it is chilled. You have to ensure that it is branded with the Coca-Cola company brand, so that customers have a look and they understand that all the beverages from the Coca-Cola company are available here. No other beverages available. Pizza Hut will have similar contract with the Coca-Cola or PepsiCo, whatever it is. Domino's also will have a similar contract. Now, McDonald's will say, you expect me to exclusively enter into a tie-up with you. You expect me to store your beverages. You expect me to do marketing and branding services for you by putting your label on the beverage dispensers. What is there in that for me? Why should I do so much of work for you when at the end of the day, all I'm doing is selling your beverage? For all that I know, I can just buy beverages from a local grocery store, keep it and sell it off to the customer. Why this deal of exclusivity should be given to you? You have to provide something for me. So McDonald's will say, the storing machine, you have to pay that for me. The storage charges, you have to pay for me. The electricity charges for the particular storage machine, you have to pay that. The annual maintenance charges, you will have to bear. The repairs and maintenance cost of that machine, you will have to bear. So, and then we are dedicating a separate space for you. We are dedicating a separate space for you. So, basically, each and every square foot is designed to earn revenue in a McDonald's store. Okay. But that store which is there, where the beverages are kept, that store is yielding revenue. That area is yielding revenue, which does not exclusively belong to McDonald's. A major part of that goes to Coca-Cola. So you have to compensate me for that also. You have to compensate me for that also. So now McDonald's will say to the Coca-Cola company, look, I am providing you with certain services. What is the services? I am paying electricity for storing your beverages, number one. I am paying, you are utilizing the space in my premises without additional rent. That is the second. The third one is a separate meter will be installed. So you know how much I am consuming on your behalf. Fourth one, your brand is visible. So the picture that's going out to the customer is McDonald's is not manufacturing or not producing its own beverages. It's relying on the Coca-Cola company. So there could be a potential loss of the reputation of McDonald's, that it is only a food company, not a food and beverage company. So all these hits I'm taking. So for that, I am expecting certain payment. Okay. So now the question is, how am I going to account for this? Okay. Both the transactions happen. Now, what the standard says is, if what is being provided by the customer to the seller in the second leg of the transaction, what is being provided by the seller to the customer, by the customer to the seller in the second leg of transaction, if it is a distinct goods or services, distinct matlab what we studied in step number 2. In step number 2, what did we study? We had two requirements for distinct goods or services. First one was, such goods or services must give benefits to the customer. And that means what McDonald's is providing should give benefit to the Coca-Cola company. Is it giving benefit? Yes. By keeping a dedicated Coca-Cola counter in their shop, Coca-Cola's revenues are increasing. So it is a direct benefit. So that part is met. Now the second part is, it should meet those three non-negative conditions. What are those non-negative conditions? First one, it should not be part of a single integration activity. It should not be a customization or modification, and it should not be highly integrated. Now, all these three things are not highly integrated. They are not highly integrated, not customization or modification or anything. And therefore, what services are being provided by McDonald's to Coca-Cola are distinct in the context of the contract. And if they are distinct in the context of the contract, the standard says that you recognize this revenue on a gross basis, and you recognize the purchase cost, separately. That means Coke will book the revenue on gross basis, and Coke will also recognize a purchase cost or a service cost. Basically, you call it as purchase cost or expenses will be booked separately. Are we clear with this? Yes. When is this possible? When and only when the services delivered by the customer to the seller are distinct in the context of the contract. The goods or services, the performance obligations are distinct in the context of the contract. Are we clear with this? Yes. Any doubts? Any issues? Any doubts? No doubts? All right. The next part. Let us modify the example. In fact, when you go to any departmental store or grocery store, or even you say pantaloons or such stores also, many times what do you see? If you go to a grocery store, near the grocery store, they keep chocolates, they keep cakes, they keep the most attractive visibility for all your junk food, your chips, your mixtures, everything is around that billing counter. If you remember, imagine you can go to any nearby store and see. Why is it kept? People stand in the queue. In the queue, kids will be there. And because the kids are going to be there in the queue, they will get bored. So they will say, Papa, give me that chocolate, give me this biscuit, give me that toffee. And you are obliged to give to keep that kid satisfied. So therefore, it results in additional revenue for the store. In pantaloons and all, what is the general trend? Near the billing counter, you are going to have small earrings, small, all these women accessories, which are not very expensive, but which are part of their day-to-day usage. Okay. Sometimes for the men, you would be having very small items, but generally you have the women items, which are day-to-day consumption-based items. So what will happen is when customers come and stand in the queue, the women will tell to the people who accompany them, you just be in the counter. I will look for some small items here and there. Jab tak billing ka number aayega, I'll come with some more steps. That is very common. Placing those goods there is a strategy, and placing a particular brand of goods there is a service that is distinct from what you otherwise provide to the supplier. That is different from the supplier. And therefore, this distinct service should be accounted separately by the seller as a purchase, as an inward expense. Yes. So it's very interesting. So the standard setters actually observed this, and they said the services provided by McDonald's to Coca-Cola, or if you maintain Ferrero Rocher chocolates, these are always close to the billing counter. Always. Okay. Always close to the billing counter. मतलब आप जाओगे, आप Ferrero Rocher देखोगे, even वो भले 3 का पैकेट हो, उठाओगे 150 or 200 rupees, whatever it is, you will pay and come. It's a strategy. Ferrero Rocher has sold the chocolates to the grocery store, and grocery store in return has given distinct services in the form of placement of Ferrero Rocher near the billing counter. it will have the most bright ambient lighting. It will have the most attractive color combinations, such that you look at the chocolate stores, the chocolate and junk food wala section, and you look at the grocery store section. There is a sea change in the lighting. There is a sea change in the way the things are presented. All that is a distinct service that is provided by the grocery store to the seller. And that is why you will have to treat it as a separate expense in the books of the original seller. Is it okay? Yes. Now let us move on to the next part. Sir, यही बात करते हैं. But in this case, if I look at the billing counter of Walmart or any departmental store in your area, in your locality, just imagine, chocolates are kept close to the billing counter, but it is not a specific brand chocolate. वहाँ Cadbury's भी है. You also have Nestle chocolates also kept there. You also have Ferrero Rocher chocolates also kept there. You also have Amul chocolates also kept. So all brands of chocolates are kept there, ताकि कस्टमर जो भी आए उठा के रख ले अपने ग्रोसरी बैग में. Now, what you are providing, is it distinct, or as a store, you are just doing your job to ensure your revenue is maximized? आप समझ रहे हैं मेरा क्वेश्चन? You are not doing anything exclusive for one of the sellers. Instead, you are doing what suits you as the grocery seller. You are not providing distinct goods or services to the seller, because in that space, you are having all brands of chocolates there. So therefore, are you increasing the revenue of any particular brand? Answer is no. You are increasing your revenue as the grocery store, but you are not doing anything special for the supplier of those goods, and therefore there is no distinct goods and services involved. There is no distinct goods and services involved. And in such cases, when no distinct goods and services are involved, what you will be doing is you will recognize the revenue on net basis. Coca-Cola company will recognize the revenue on net basis. If customer does not provide distinct goods or services, then recognize sales on net basis. Recognize sale on net basis. Yes, that's right. They give some things which you don't need only. Okay, so all those things will come there. Sometimes they keep some small lock, something small, they will keep it there. Batteries, okay. These batteries means the cells which are there, okay. 1.5 volts वगैरह वगैरह, वो जो छोटे छोटे सेल आते हैं, AA, AAA, वहीं पे रख देते हैं. Keychains, they keep it there only. Now, these are all small things. Customer देखेगा, अच्छा हाँ, we need this, चलो डालो अंदर. Yes. So therefore, you are having this. So if you do not give a degree of exclusivity to your seller, you are not giving distinct goods or services. But you bill the Coca-Cola company, you bill the Ferrero Rocher, you bill the Cadbury company, you bill Nestle's. But the substrata is, are you giving distinct goods or services? Answer is no. You are not giving distinct goods or services. You are just stocking them in the grocery. You are just stocking them in the grocery. So when you have a bill which is not accompanied by distinct goods or services, does not provide distinct goods or services, but there is an invoice that has gone from the customer to the seller, then what the seller will do, what Coca-Cola, what Cadbury will do is, they will book their revenue on a net basis. They will book their revenue on a net basis. Sir, net basis meaning the Coca-Cola company or these companies have first sold their goods to the grocery store. So that is suppose 100 rupees. And these placement services in the grocery is not distinct, but the bill has gone from the grocery to the Coca-Cola company for, let us say, 25 rupees. So if the services provided are not distinct, the placements are not distinct, then the chocolate company or Coca-Cola will recognize revenue as 100 gross minus 25 expense. It will recognize revenue at 75. It will recognize revenue at 75. If 25 is a distinct obligation, then revenue will be 100, expenses will be 25. Revenue will be 100 and expenses will be 25. So this is how you will evaluate. This is how you are going to evaluate. Why was this a problem? Why was this a problem earlier? This was a problem because many entities used to jack up their revenues, with such kind of arrangements. Many times, nothing would be provided only, but the seller would say, "Bhai, you give me an invoice saying that you have stocked my goods at such and such location. I will bill you at a higher revenue and you recover the cost from here." So what is happening is the Coca-Cola company or these type of companies, they are artificially enhancing their revenue. They are artificially inflating the revenue. P&L may impact is not going to be there, because you are getting a corresponding cost hit in the P&L, but you are inflating the revenues. And by inflating the revenues, what happens is you are giving a fraudulent sense of growth to the reader of financial statements. वो आपका revenue है ही नहीं sir. It's not your revenue. It is an accounting adjustment, a manipulation that you are doing, and that is why this clauses were introduced. Okay, many times in this Amazon big billion day sale, vagera. So in the big billion day sale, what happens is there are two types. They will again give you on the landing page of the Amazon website, big billion day sale, buy electronics, buy footwear, buy bags, clothes, this, that, everything at attractive discounts. This is one side of the advertisement. The other side of the big billion day sale, you can look exclusive big billion day offering. Oppo is giving 25% discount on all its items. Vivo is giving this much discount. New release by Motorola included here. On one side, you are giving general items. On the other side, on your website, you are giving separate prominence to brands. So therefore, this exercise, what you are doing is giving visibility to these brands on your web page. In other words, you are doing something distinct for these brands, and therefore Amazon will be raising an invoice on these entities. Many times these entities have entered into exclusive contracts with Amazon or Flipkart. For example, Motorola is exclusively sold on Flipkart. So Flipkart will directly bill Motorola for the placement services that it is giving on the website. So there also, if it is distinct, which it actually is, then Motorola will book the revenue from sale of phones to Flipkart. There will be an inventory in for Flipkart, and thereafter there will be an cost in the form of placement of ads on the home page of Flipkart. That will be a distinct offering. Is it okay? Yes. Is it fine? Any doubts? No doubts? All clear? Have you understood? Okay. Now, many times what will happen is they again want to jack up their revenue in these arrangements also. Companies want to jack up their revenue in these kind of arrangements also. So what these entities will say is, look, you are giving me distinct goods or services. The fair value of that service is 25 rupees. So you have seller to the customer, this was rupees 100. Customer to the seller supplies goods or services of 25. Now, if these are not distinct, then revenue to be booked will be 75. Revenue to be booked will be 75. Now let us move on to the next one. Distinct है, but the seller is still not happy. वो बोलता है खाली 100 rupees, only 100 rupees. No, let us jack up our revenues. So therefore, the seller tells the customer, look, you are giving me a distinct obligation, a distinct performance obligation. So what I will do is, instead of 100, I will increase my selling price by 50. I will make it 150. Why should I pay you 50 rupees extra? Customer bolega, don't pay me 50 extra, na. Instead of 25, you sell to me at rupees 75. You sell to me at rupees 75. So therefore, seller to customer revenue is jacked up by 50 rupees. Customer to seller revenue is again jacked up by 50 rupees. So therefore, to curb this kind of manipulations, to curb these type of arrangements, what the standard says is, excess over fair value by customer to seller shall be treated as reduction of transaction price, remaining treated as purchase. Remaining treated as purchase. Are we clear? So in this case, fair value is 25. 75 is the billing amount. Excess over fair value is 50. So what the standard says, excess over fair value 50, you will treat it as an adjustment to the transaction price. So 150 minus 50, it falls back to 100. And 75 will become 25 in the books of the seller, when he does the expense accounting entry. Expense will be accounted at 25, and the 50 extra amount will go as a reduction from revenue. If there is no distinct goods or services, then to question hi nahi utta, you just do it on a net basis. Are we clear with this? I'll give the presentation in a couple of days. You will get everything what I have spoken, each and every word. Okay. How would you determine the fair value? That is a subject matter of Ind AS 113. Okay. You could look at marketable prices. You could look at prices in respective grocery stores in respective thing. Okay. So there is a clear-cut mechanism for determining the fair value in Ind AS 113. You will follow that mechanism. You will follow that particular mechanism. Is it okay? Yes. Have you understood? You have to understand one thing. That intention is to recognize revenue at fair value. You cannot jack up the revenue. Revenue is one of the most crucial numbers. By jacking up the revenue, what will happen is even the audits will start getting impacted, because materiality goes on increasing with increase in revenue. And therefore, the chances of not detecting material misstatements goes high. Are we clear with this? Yes. Any doubts? No doubts? Yes, others. Mohammed, did you follow? Yedu, Rajiv, Shruti, Madhu, Aditya, Leena, Sailesh, Deepak, did you guys follow? Yes. Yes. Okay, fine. So that kind of concludes our discussion on so this part is done, consideration payable to a customer. You can go through these examples. Okay, you can go through these examples. It's exactly what we have discussed. Okay, and you can go through these illustrations also. Principles you remember, illustrations are doable by themselves. Okay. All right. Now we come to the next step, allocating the consideration to the performance obligations. Allocating considerations to the performance obligation. This is step number 4. This is step number 4. Okay. See, in audit, what happens is we assign materiality. When we assign materiality, materiality will typically be a percentage of revenue, one of the indicators. If you read SA 300 series, materiality may they give an example that it could be taken as a percentage of revenue. So when you're artificially jacking up your revenue, increasing your revenue is 100. Materiality at 2% will be 2 rupees. But if you have jacked up your revenue to 150, at 2%, it becomes 3 rupees. So therefore, your materiality assessment, initially at actual revenue, the materiality is 2 rupees. Any misstatement above 2 rupees, you will report. If they have artificially hiked the revenue, then your materiality will become 3. Actually, any error of 2.5 rupees should lead to a qualification in the report, because it is technically above the materiality level. But because of jacking up of revenue, your materiality level also has gone up. As a result, these misstatements could go unreported. Now the question is, sir, instead of 75, can't we take 25 and make it 150 minus 25? No. 25 is, see, understand, if you are providing distinct goods and services from customer to the seller, that should be at fair value. If it is above the fair value, 25 ke badle 75, that incremental portion of 50, the standard deems it that you have manipulated the customer to increase your sales. So anything more than the fair value, you will reduce it from the transaction price. That means 150 transaction price minus 50, so that gives you 100. I will not net off the original fair value, because this is a case where distinct goods and services are provided. Where distinct services are not provided, it really doesn't matter, because what you are doing is ultimately netting off and recognizing the revenue. So there is no problem if there are non-distinct goods and services or non-distinct performance obligations satisfied. Is it okay? Yes. So that kind of concludes the third step. Fourth step, allocation of transaction price. See, we've done this. Okay, right from the first example, we have done this. Okay, so only thing is, we have certain norms to follow. Okay, the norms are also very simple. You follow those norms, you will get the allocation. So first thing, how am I going to allocate? Look at the example of the very first example that we did. Car sale, 3-year warranty, 5 free services. Now, I have a total price of 15 lakhs, and separately I am also providing standalone services. So the first preference on allocation, goes to whether I am providing the same goods or services on a standalone basis. That is the first preference that you are going to look at. You will look at your own preferences. You will look at your own supplies. If I am providing these goods, these services separately on a standalone basis, then you will allocate the transaction price on the basis of the standalone prices of those goods and services provided by you. This is the first step. So allocate the transaction price on the basis of standalone prices provided by the seller himself or herself. Is it clear? Yes. Is it clear? Have you understood? Yes. Okay. Shruti, I hope you are convinced about that 75 and 25. Okay. All right. Now, first method of allocation you have understood, right? Any doubts? Any difficulties so far? Okay. Now we move on to the next. Sir, what if I don't provide them on a standalone basis? मेरे portfolio में है ही नहीं sir वो goods and services separately. I always bundle them and give. Why should I make my own life difficult by providing separate revenue streams, raising invoices at all point of time? Why should I do that? I will always bundle and give. My life is easy, customer's life is easy. लेना है तो लो, नहीं लेना है तो मत लो. Okay, so that is the philosophy I followed. So I myself have never provided car without warranty, warranty without car, or only free services. मैंने ये कुछ भी किया ही नहीं है. So therefore, I cannot look at my own data because I don't have data of standalone prices in the first place. First point. Second point. तो अब कैसे करें? How do I allocate? Sir, you can allocate based on your competitors' prices. See, you can go to the competitor and ask, what are the prices of standalone car that you give? What are the prices of the standalone, what are the prices of the standalone warranty services or of the free services? So then he will tell you. You go as a customer, he will tell the prices as he would tell to a customer. So take those prices, market assessment, that will be the fair value of the standalone obligations, and then you allocate your transaction price in the ratio of those prices that are quoted by the prices that are quoted by your competitors. Okay, so this is known as a market assessment approach. So if I have to look at allocation, of transaction price, first preference, standalone prices of goods or services provided by entity. Number one. Second, if I do not provide them separately, you will look at standalone prices of goods, services provided by competitors. Pizza with 500 ml, a combo offer, versus pizza provided separately, drink provided separately. How are you going to allocate? Pizza Hut gives the pizza also on a standalone basis, gives the drink also on a standalone basis, gives pizza on standalone basis and link also on and drink also on standalone basis. So just allocate it in that ratio. Just allocate it in that ratio. Okay. If you don't do on standalone basis, then on the basis of the competitor standalone prices, you can follow. So इसको हम लोग बोलते हैं market assessment. Market assessment. Okay. And then third one, cost plus approach. Cost plus approach. If you don't provide on standalone basis, industry also doesn't provide on standalone basis, तो हम किसी का नहीं देख सकते. Then the third one is, you know the cost of each product or performance obligation. गाड़ी का cost कितना है, warranty कितना है, service cost कितना है, each of these costs are known to you. Each of these costs are known to you. So take cost of each distinct performance obligation. Cost of each distinct performance obligation plus a reasonable markup. Plus a reasonable markup. That will be the price. On that price, you do the allocation of the transaction price. You do the allocation of the transaction price. Are we clear with this? Yes. Are we clear? Any doubts? Anybody? Yes. Anybody has any doubts? Yes. And finally, if this method also does not work, then you follow the residual method. Acha, what is the residual method? Okay. I have car warranty servicing. Free service. Car is never sold on standalone basis. So no observable price. No observable price. ना मेरे पास है, ना मेरे कस्टमर के पास है, ना मेरे पास है. I don't have. My competitor does not have. Even when I purchased, I also got it with a warranty. So therefore, I also don't know what will be the standalone price. So therefore, we will look at the other prices. Your total price was 15 lakhs. You go to your competitor and ask कि भाई free service का cost कितना है? He will say, मतलब pricing कितना है? So he will say 45,000. Okay. Servicing cost कितना है? Sorry, warranty cost कितना है? Sir, that will be 90,000. That will be 90,000. Observable price. Observable prices. So, bus, what will be the value of the car? 15 lakhs minus 90,000 minus 45,000. So 15 minus 1 lakh 35,000. 15 lakhs minus 1 lakh 35,000. 13 lakhs 65,000. residual approach, residual approach, balancing figure approach, balancing figure approach. Is it okay? Yes. Are you clear with this? Are you clear? Yes. So allocation of transaction prices follows a 4-step hierarchy. सबसे पहले, if I am providing the standalone goods and services, refer to my standalone prices. Number one. Second, I don't perform, but my competitors are performing on standalone basis. So market assessment approach. Second. Third one is neither you perform nor your competitors perform, but you know what is the cost. So to the cost, you add a reasonable markup and you arrive at the standalone prices. On that basis, cost plus markup figure, you are going to recognize the allocation. Number three. Number four is neither you do the standalone sales, nor your competitors does, nor you know the cost of the standalone product. Then what you are going to do is this way. On a residual basis. Okay. So that takes care of the 4 steps. Okay. Now, let us take one example. Of disproportionate allocation. Let us take one example of disproportionate allocation. See. See, I have 4 products, A, B, C and D. Okay, which the standalone prices of these products are 15,000, 10,000, 10,000. So this comes to 50,000. Now, you have sold these products, all 4 of them together, for 45,000. You have sold it for 45,000. So therefore, ideally, pro rata allocation, not allotment, pro rata allocation. How would I do? 45 by 50 into 15, 15, 10 and 10. So that gives you 13,500, 13,500, 9,000, 9,000. So 45,000 is divided in the ratio of the standalone selling prices. This is ideally what would be done. Okay. Now let us look at, I'm slightly changing the facts now. When you go to the selling team and ask, your sale numbers have come. Now, any comment you want to make on that. So the sales department will say, look, there is one sale of A, B, C and D put together valued at 45,000. But actually what will happen is, I gave a discount of 5,000. 50 minus 45. I gave this discount of 5,000 only and only because these products, C and D, these 2 products, these 2 products are not selling well. So poor sales. So to what you can say, to conclude the discount of 5,000 is attributable only to C and D. It's not attributable to A and B. It's not attributable to A and B. And therefore, the allocation looks something like this. Disproportionate allocation. Disproportionate allocation. How do I do this allocation? Sir, सबसे पहले total transaction price is how much? Sir, this is 45,000. This is 45,000. Now, am I giving discount to A and to B? Answer is no. So 15,000. 15,000. Are we clear with this? Yes, 15,000 and 15,000. 45,000 is the total transaction price, out of which 30,000 you have allocated. You are left with 15,000. 15,000 you are going to divide it. 15,000 you are going to divide it in the ratio of the original standalone prices, that is 1:1. So that takes care of the allocation as 7,500, 7,500. So this is the basis for allocation. This is the basis for allocation. Are we clear with this? Yes, are we clear? Did you follow disproportionate allocation? Did you follow disproportionate allocation? Yes. So the discount of 5,000 is allocated only to C and D. Only to C and D. Okay. Yes. All right. So these are the basic principles of allocation. These are the basic principles of step number 4. Yes. All right. All right. Fine. If we have variable concession. Okay. Now, suppose your performance obligations are 4, A, B, C, and D. If performance obligations are 4 and you have a variable consideration attached to the contract, and the variable consideration is allocable only to one of the performance obligations, not to all. It is allocable only to one of the performance obligation, then you will allocate variable consideration only to that particular performance obligation. You will allocate it only to that particular performance obligation. Are we clear? Yes. So it's a common sense. So A, B, C and D में से if variable consideration is there only for A, तो आप obviously A को ही allocate करोगे. You will not do it for all of the what you can say, you will not allocate it to all the remaining performance obligation. ये तो common sense है. Now there is another final check in step number 4. After allocation, after you do the allocation based on the above 4 principles. Which 4? If I'm giving standalone goods and services, refer those prices for allocation. If I don't give, my competitor gives, refer his pricing. So this is the second one. Third one is cost plus approach. Cost plus approach. And fourth one is which one? Residual approach. So these 4 approaches coupled with variable what you can say, coupled with variable consideration, then the variable consideration is allocable to which performance obligation you will have to identify. You will have to identify. Is it okay? Yes. Have you understood? Beyond this, there is an overriding principle. What is the overriding principle? After you do the allocation, the result of that allocation should make sense. The result of that allocation should make sense. When I say it should make sense, I mean to say that suppose you expect an amount to be received of 9,000 rupees, but you have received only 7,500. So now the question is this allocation in line with the expected value that you want to receive? Answer is no. And therefore, if residual method gives prices above the range, then ignore the residual method and follow the other method. So that is fairly simple. You don't have to do much in that. Okay. So we'll quickly do one question on the allocation aspect. Yes, because this is slightly important. I'll be taking it up myself. Yes. Read illustration 55. I'll just come. Okay. An entity regularly sells products X, Y, and Z individually, establishing the following standalone selling prices. X, Y, Z standalone price is given, total is 1,20,000. Additionally, the entity regularly sells Y and Z together for 50,000. Okay, now, case A, allocating a discount to one or more performance obligations. The entity enters into a contract to sell products X, Y, and Z in exchange for rupees 1 lakh. The entity will satisfy the performance obligations at different points in time, or product Y and Z at the same point of time. Determine the allocation of transaction price to products Y and Z. Okay. All right. So now let us start. Illustration 55. Okay. Okay. Case A. How am I going to do this? X, Y, and Z together, it is 1,20,000. So, discount to larger bundle is equal to, sir, standalone price is 1,20,000. Combined price is 1 lakh. So that means 20,000 is the discount. This is X plus Y plus Z. This is X plus Y plus Z. Discount to smaller bundle. Discount to smaller bundle. Y and Z only. How much it was? 45 plus 25. 70,000 minus 50,000. Where they have given 50,000? C. entity sells these together for 50,000. So that gives you 20,000. Therefore, in the larger bundle, you have given a discount of 20,000. In the smaller bundle also discount is 20,000. That means X is never sold for a discount. X is never sold for a discount. Discount is only for Y and Z. So therefore, discount only to Y and Z. Discount only to Y and Z. So how do I do the allocation now? How do I do the allocation now? Allocation goes something like this. Total price is 1 lakh. Total price is 1 lakh. Now, X is never at a discount. So this will be 50,000. X is never at a discount. So this will be 50,000. The remaining 50,000, I will allocate it in the ratio of standalone prices of Y and Z. So this will be 50,000 into 25,000 by 70,000. So that will be 50 into 25 by 70, and Z will be 50 into 45 by 70. 45 by 70. So कितना होगा? This will be 17,857 and 32,143. So that is how you will do the allocation. Allocate transaction price of 50,000 in ratio of 25 is to 45. 25 is to 45. Are we clear? Yes? No doubts? Noted down, everyone? Noted down? Yes? Okay. So let us move on to the next one. Case B. Residual approach is appropriate. Let us see how it is. The entity enters into a contract to sell X, Y, and Z. It also includes a promise to transfer product alpha. So you have X, Y, Z, and alpha. Okay. Now, total consideration is 1,30,000. Standalone selling price is highly variable because the entity sells product alpha to different customers for a broad range of amounts ranging between 15,000 to 45,000. Determine the standalone selling price of X, Y, and Z and alpha using the residual approach. Okay. So case B. Case B. They are saying that you have 4 products now, X, Y, Z, alpha, and that this particular thing is going to be sold entirely for 1,30,000. Okay. So let us see X, Y, Z. Standalone prices 50,000, 25,000, 45,000, 1,20,000. Alpha total is 1,30,000. Standalone prices are not visible, so residual approach remains appropriate for alpha. So alpha is 10,000. Alpha is 10,000. Are we clear with this? Are we clear with this? Yes. Done. Noted down. Is this allocation correct? Is this allocation correct? See, for alpha, I am allocating 10,000. But actually they have given it should be between 15 to 45. So this allocation is not correct. So how do I do the allocation? Let me look at allocation based on case A. Let us do the allocation based on case A. So 50,000 17,857, 32,143, total is 1 lakh. This is 1,30,000. 30,000. Yes. This particular method does not make sense because price allocated to alpha of 10,000 is not equal to the range of prices which were prescribed for alpha, and that is why we took the standalone price, added your what you can say allocations, and then determined the balancing figure for alpha. So that comes to 30,000. This is within 15 to 45,000 range. Within 15 to 45,000 range. Are we clear with this? Yes. Are we clear? We cannot take 10,000 because they have said the range should be between 15 to 45,000. Yes. Done. Understood the second allocation? Okay. Done. Now we move on to part C. Facts are same except that the transaction price is rupees 1,05,000. Okay. So case C. Just a minute. Okay. So case C. Total transaction price is 1,05,000. Rest all as case B. So X, Y, Z 50, 17,857, 32,143, 1 lakh, alpha, is this 5,000 within 15 and 45? Answer is no. And because it is not within 15 and 45, is this allocation acceptable? Answer again is no. And therefore, not within 15 to 45,000 range. Hence, adopt alternative valuation methods. Cost plus valuation हो सकता है. It could be observing the fair values. Okay. So you have to adopt alternative. You cannot do this because it's not falling within that range, and remaining all data is not given to us. Remaining all other data is not given to us. Okay. Are we clear? Yes. So that takes care of step number 4, allocation of transaction price. Okay. I would request you to try 56 with variable consideration. Okay. वो थोड़ा सा different है, but I think you will be able to solve it. Okay. I think you will be able to solve it. So we are done with step number 4 in totality. Nothing else is there. We now come to revenue recognition. Okay. Step number 5. We have to complete this fast. We don't have time. Major concepts. Most of the things you have already understood now. Now the only thing that we now have is recognizing revenue as and when the performance obligations are fulfilled. Okay. So once we start this, all the hard work that we have done till now is for this step. Step number 5 actually gives you the credit in the P&L of the revenue. That is the meaning of step number 5. So all terms, terminologies, effects, explanations, everything is done. अभी खाली खत्म करना है अपने को last step. Okay. Now, when do I recognize the revenue? I'll give a break after some time, Mohammed. Okay, because there is lot to be done actually, lots and lots to be done. So I'm just seeing when to give you a break. So give me some time. I'll give you a break shortly. Okay, I'll give you a break shortly. There are cases of repurchase agreements. Then you have revenue over a period of time, revenue at a point in time, and then you have service concession arrangements. Okay, so there are a lot of things to discuss. Let us see how much we can do in the next one hour or so. Okay, so recognition of revenue will happen on either of the two time related criteria, either of the two small criteria. Okay, the small criteria, either of the two criteria. The first criteria is revenue at a point in time, or second one is revenue over a period of time. So these are two very crucial terms which are used. So far I have been using those terminologies, at a point in time, over time, at a point in time, over time. Abhi samajh mein aayega what do we exactly mean. When I say goods or services, transfer of control means my customer is now getting exclusivity over that product, over that asset. When I say asset, I mean a contract asset. I don't mean machinery, land, building, etc. It could be a contract asset. You are making an inventory item for the customer. For him, it is an asset, though it is an inventory. Okay, so don't get confused by the fact that you are having what you can say. You are having. I just lost track. One second. Goods or services. Okay, sorry. So, control is giving exclusivity on the asset. It could be inventory, it could be machinery, it could be any contract asset. For the customer, what you are going to give is an asset. So therefore, don't get confused by use of the term asset. You rather focus on the fact that what you are getting is a satisfied performance obligation from the seller. Okay, so that is the meaning of control. You have the exclusivity over that product, over that service. Only you and you can enjoy it, and you can prevent others from enjoying it. So this is known as a preventive right. You bring a mobile phone. The moment you bring a mobile phone, what do? You put a password. You do face recognition. You do fingerprint recognition. वो सब कुछ करते हो so that nobody sees your mobile phone without you giving them access to it. So you are using the asset the way you want. You can make calls on it. You can watch video sessions on it. You can listen to music on that. You can use your WhatsApp on that. You can surf internet on that. So you are the one who directs the use of that asset, number one. Second is, by preventing access to others, you have a preventive right in respect of that asset. इसको बोलते हैं हम लोग control. We call this as control. This control can be transferred at a point in time or over time. Either of the two things. At a point in time or over time. So, what do you mean by at a point in time? At a point in time is a residual category. The standard defines transfer of control at a point in time as if the transfer of control is not over a period of time, then it will be a point in time. So what is the meaning of control over time? Very simple concept, okay? Transfer of control over time. Transfer of control over time. Three conditions are there. Any one condition you meet, it means control has transferred over time. If you do not meet any of these conditions, it means control is transferred at a point in time. Okay. So what are those three conditions? What are those three conditions? Okay. So let us understand. First one. Entity renders services. That is performance obligations, and simultaneously consumer or customer consumes the benefits by such performance. By such performance. Okay. So this is the first step. Okay. This is the first step. Entity renders services, that is performance obligations, and simultaneously the customer consumes the benefit by such performance. Okay. Sir, matlab kya hai? Okay. You are attending classes, so therefore example becomes very easy to explain. As and when the sessions go on, institute is rendering this service. You are also consuming it simultaneously. You are also consuming it simultaneously. तो इसको हम लोग बोलते हैं over a period of time, we are providing the service and you are consuming the service. You are consuming the service. Although there is no consumer-supplier relationship here, but nevertheless, you take any general class for that matter, as the classes progress, your consumption of benefits also happens simultaneously. Consumption of benefits also happens simultaneously. So the test that you have to ask is, if the entity is removed from the service, if the entity is removed from the service, and a new entity is appointed in its place, then what would be the scenario? Would the new entity start from beginning, or would he start from where he would have ended? Hypothetically, suppose you came to me for sessions, and suppose you people ended up paying charges. Okay. Now, I taught you revenue standard मैंने पढ़ाया. You people did not like my teaching. Okay. I did not teach well. So you did not like my teaching. So the moment the standard gets over, you people say that sir ko nikalo, he is not teaching well. The new professor who comes and takes your session, will he start from scratch or will he start from the point where I ended? Ideally, he will start from where I have ended. He will start from where I have ended. And therefore, you have consumed the benefit over time. What the new professor is going to say, look, you paid fees and that part of obligation is already done. Completion of the standard on revenue is already done. And therefore, we are not going to do that standard again because we have provided and you have consumed the benefits of that. So therefore, what we are now going to do is we are now going to provide the obligation after revenue standard. Jo bhi bache hai, we will be teaching that, but revenue standard we are not going to do because that is done by me earlier. Is it okay? So इसको हम लोग बोलते हैं revenue obligations being performed and simultaneously being consumed. Okay. Now let us take another example. Then you will be absolutely clear. Deloitte resigned from Byju's. Okay. Deloitte resigned from Byju's. Real life example. Okay. It has performed some audit procedures, probably. It has performed some audit procedures, probably. Because of whatever reasons it has given, it was constrained to resign from the audit responsibilities of Byju's. It elected to resign. Now, in its place, you have another firm that has come. I think BDO has come. I'm not sure. Now, when BDO has come, will it perform the audit from the place where Deloitte left, or will it start performing as a new assignment altogether? What do you think? What do you think? Will it start performance altogether as a new obligation, or will it start from where Deloitte had left? What do you think? Yes? It will be started off as a fresh assignment. That means whatever work has been done so far, the benefit of that has not been consumed by the customer. The benefit of that has not been consumed by the customer, and therefore, this condition would not be met. This condition would not be met. Okay, are we clear? So first condition is understood. Second condition, customer controls the asset and the entity's performance creates or enhances the asset. You will not start from where Deloitte has left. Na, Mufita. No, you cannot. You have to start. Put yourself in their shoes. You get a new assignment. Do you think Deloitte will share the working papers? These are our observations. These are our work. This is what we had concluded. You start from here. Do you think the new firm will do like that? Do you think you will do like that? You will say, yaar, Deloitte ne jo kiya, so kiya. That is Deloitte's working papers. I have to start afresh because I have to gather evidence about each and every number appearing in the trial balance. So my job is again going to start from the scratch. Okay, from the scratch. Okay, all right. Transfer of control over time. Second condition, customer controls the asset. Entity's performance creates or enhances that asset. Creates or enhances the asset, for example, painting or false ceiling. House is yours. House is yours. You are controlling. Color आप choose करते हो, texture you choose of the paint, everything you choose. But what the entity does is the entity performs the painting services. or the false ceiling services. By performing these services, the asset is created or a new asset is enhanced or the existing asset is enhanced. And therefore, this is known as transfer of control over time. This is known as transfer of control over time. Okay. You are enhancing the existing asset of the customer. You are enhancing the existing asset of the customer. Second. Third case, entity is making a product with no alternative use. With no alternative use, and entity is entitled to no beta. Using the work of others will be SA 600, 601. That is using the work of an audit expert, etc. It won't be this, what example I gave. This won't fit that. Okay. Entity is making a product with no alternative use, and entity is entitled to pro rata compensation. Pro rata compensation. Okay. If work was terminated midway. If work was terminated midway. So entity is making a product with no alternative use. Suppose you are an entity designing a missile for the defense or a space rocket for ISRO or an aircraft for Indigo. Okay, कुछ भी, कौन सा भी example ले लो. Now Boeing कहो, aircraft बोलो, whether it is a missile or a space rocket. Do you think these contracts will suddenly, like how you manufacture small products, do you think these will suddenly come into existence? Answer is no. They take substantial time, sometimes multiple years they take time. A shipbuilding contract, Mazgaon dock has to build a ship for the Navy. Do you think ship रातों रात बन जाएगा? Do you think वो महीनों में बन जाएगा? अरे ship building is one of the most complex activities. So ship बनाना है, it's a good 2 to 3 year assignment, particularly warships, because they need to have that equipment, they need to have those connectors, those boxes. You need to put a runway on that aircraft because your fighter jets will land on that. So it's a humongous task. It spans over 2 to 3 years. And therefore, if Mazgaon dock is making a fighter ship, what you call that aircraft carrier for the Indian Navy, it spans over 3 years. It spans over 3 years. Now, do you think, suppose tomorrow Navy says, I don't want this warship. Do you think you can sell it to somebody? Do you think Mazgaon dock will come to you and say, ले लो यार, you can take this ship because now Navy is not buying? Forget us. Do you think he can go to one of the richest men of India, he can go to Mukesh Ambani and say, bhai, take this aircraft carrier, you can buy anything and everything, please buy this. Do you think Mukesh Ambani will really buy that? What is the use for Mukesh Ambani? Yes or no? And therefore, there is no alternative use. This can be used only for the Navy and only the Navy can use it. Nobody else, number one. Second, because the contract gets terminated midway, do you think Mazgaon dock will get some compensation? Answer is yes. Yes, they will get a compensation. And therefore, if even this condition is fulfilled, then we can say that transfer of control over time. Are you clear with this? Yes, are you clear with this? Anybody has any doubts? Yes, no doubts? Yes, doubts? Yes, all clear. So if any of these conditions, these are or if any of these conditions are fulfilled, we can say that performance obligation has been transferred over transfer of control over a period of time. Transfer of control over a period of time. If it is not meeting any of these criteria, it will be transfer of control at a point in time. At a point in time. Are we clear with this? Yes, absolutely clear. No doubts. Do you have doubts? Do you have doubts? No doubts? Yes, doubts? Are we clear? Yes. Understood? Okay, I hope you guys have understood. Okay, fine. Now, what is the change between AS9 and Ind AS 115? It is visible here. It is visible here. Okay. Take example of Musgaon Dock Limited. Take example of Musgaon Dock. Shipbuilding. 3 years contract. When do you think Musgaon Dock would recognize the revenue? When do you think Musgaon Dock would recognize the revenue under Ind AS, under AS9? Sir, risk and reward get transferred after 3 years. So I will recognize the revenue after 3 years. I am absolutely clear on that. This was what AS regime used to tell. You will recognize the revenue. You will recognize the revenue on sale of the aircraft based on the invoice price, based on the invoiced amount. So you will first check the invoice. You will do the booking as per the invoice, and then you will follow up with what you can say. You will follow up for the remaining activities. But first thing is risk and reward is transferred, only then you book the revenue. So this is the problem with AS9. Ind AS 115 treats this as a long-term contract, and based on percentage of completion, revenue is recognized, profit is recognized on a periodical basis. Profit and what you can say, revenue is recognized on a periodical basis. Okay, but the first case, revenue comes only at the time of signing the transfer of the ship to the Navy. Signing the transfer of the ship to the Navy. Only that point of time revenue gets recognized. Only at that point of time revenue gets recognized. Are we clear with this? Yes. Are we clear with this? Okay. So if we talk about transfer of control over time, revenue can be recognized in two manners. One is output method and the other is input method. One is output method, one is the input method. What do you mean by output method? Look at the total output. What was the total projected output? And then you give the revenue workings based on that. Okay. So for example, you are constructing a 20-storied building. You are constructing a 20-storied building, and out of 20, you have completed 6 floors. You have completed 6, or wait a second. You have completed 8 floors. You have completed 8 floors. So that gives you how much? 8 divided by 20. You have completed 40%. You have completed 40%. Are we clear with this? Yes. And finally, output method हो गया. Then we come to input method. Input method is very simple. Cost incurred divided by total estimated cost. This is my cost method. This is my cost incurred method. Are we clear with this? Yes. Are we clear? Yes. Any doubts? So basically, we have to measure the percentage of completion at each stage. We have to measure the percentage of completion at each stage. Okay. And thereafter, you can recognize the revenue. Okay. Okay. So we take a small break here, 5 minutes break. And after the 5 minutes break, we shall continue. Today, I think we should be in a position to conclude the chapter. Okay. After this, there is one repurchase agreement. You can go through that yourself. I'll explain the principles. And then I take up service concession arrangements. Then we are almost done with it. Okay. All right. We take a 5 minute break now. Shall resume. All right. Welcome back, guys. So, the question that now arises is, sir, which one is more appropriate, input or output? It depends on facts. Okay, it depends on facts. Sometimes if your input method is giving you a better clarity, you can go ahead with that. Output, if it gives more clarity, you can go ahead with that. Now, let us just take some discussion on the input method. Okay. Sometimes there may be some material, which you purchase, which is significant in terms of cost, but it does not really add value to the project. Okay. But it is essential. For example, you are doing a construction contract, you purchase land. Now your project value, revenue from your project is roughly 400 crores, and the land cost itself is about 150 crores. Now, the moment you purchase land, if you follow your input method, sir, मैंने land खरीदा 150 crores, project का cost I estimate is 400 crores. So 150 divided by 400, the percentage of completion is 37.5%. Sir, so we recognize revenue 37.5%? ऐसा नहीं होता है. You have purchased something, but what you have purchased, you have not modified, not done any change. Control of that also is given, but it's not really contributing to progress. Before you start a project, you have to buy the land. Usme to there is no negotiation. You need to have the land. Now, merely because it is a substantial cost that is there, you cannot say that much revenue should be recognized. Arey, how can you recognize? You have not even started the work. Abhi to sirf you have purchased the land and kept. You have not even put one foundation stone for starting the project. Let me go even to that extent. How can I recognize the revenue? You cannot recognize the revenue. And therefore, what the standard says is, if a particular cost meets 4 criteria, then it will not be considered in measuring the progress. A lift, buying a lift for a particular construction contract. You buy a lift का cost material होता है. It is a material cost. But will you, mere acquisition of the lift, is it sufficient to say I have completed that much percentage of the contract? Answer is no. You just bought the machine equipment. You have not done anything on that. And therefore you are going to, you are going to exclude that from the measurement. Okay. So 4 cases. First one, goods, services should not be distinct. You are not transferring lift, you are not transferring land, you are transferring the whole constructed project, the complex, to the customer. They should not be distinct. Elevator is integrated with the building. Second one, land is integrated with the project. Amount should be substantial. What is substantial? Nowhere it is defined, but it should be a substantial cost. Third one, mere purchase should be done. No need for modification or customization. And fourth one, control of such material is transferred to customer before services are performed. Before services are performed. Okay. So all these conditions are fulfilled. Then what you are going to do is, if all these conditions are fulfilled, a lift or a land, all these conditions are getting fulfilled. Okay. It's not distinct. You are integrating it with the project. Amount should be substantial. They are. Purchase only is sufficient. Don't think about modification or customization. And fourth one is control is transferred before services are performed. If all these cases are done, then if all these conditions are fulfilled, measure stage of progress excluding such materials. Measure stage of progress excluding such material. Okay. All right. So therefore, example, estimated cost equal to 200 crores. Cost incurred is equal to 25 crores. 25 crores. Okay. Lift is equal to 30 crores. Lift is equal to 30 crores. This is cost incurred excluding lift. Okay. Excluding lift. Now, let us look at this. Lift is a significant addition. आपने लिफ्ट ला के खरीदा एंड उधर ही रखा साइट पे. You have just bought and put it there. ThyssenKrupp or Otis, they have just supplied the lift to you. It's neither commissioned, nor installed, nor serviced, nor running, nor modified, nor customized. Nothing has happened. आपने वो lift खरीदा. That lift is just delivered to the construction site. That's it. Now, ideally, if I go by pure English, I have incurred 55 crores on a project of 200 crores. So if that is the case, what is the degree of completion? 55 by 200. Sir, 27.5% is complete. 27.5%. We should recognize revenue based on 27.5%. The standard says wait. Out of 200 crores, 30 crore was the cost of the lift. Out of 55 actually incurred, 30 is cost of the lift. So your actual completion is 25 by 170. So what you have completed is only 14.7% and not 27.5%. Lift ke saath what have you done? Have you installed? It's just purchased out. The fact that its cost is significant is increasing your degree of completion artificially. So remove those costs from the revenue also, from the numerator also. And then when you estimate, it's actually less than 15%. And so you have to book the revenue based on 14.7%. Based on 14.7%. Are we clear with this? Yes. You can see the distortion. There is nearly a 10% inflation of revenue if we just take the lift into the workings of percentage completed. Workings of percentage completed. Are we clear? Yes. Next, where units are incurred uniformly, then follow straight line method. Example, membership fees. So in a society, you collect subscription fees for running the society. Take it to revenue on a straight line basis. Streaming, Netflix, etc. take it on a streamline basis. Magazines, take it on a straight line basis. Okay. Standby equipment, generator given for power backup, consider it. Generator given for power backup, consider it. Okay, though it is used intermittently. Okay, so with this, you can do question number 65. I will be giving you notes on sale and repurchase agreements. We have done a small discussion of sale and repurchase when we did the conceptual framework. If you recollect, I have sold an item for 1 lakh and I purchase it for 1,10,000 after 1 year. So selling for 1 lakh and purchasing it back for 1,10,000, I kind of remember vaguely that we had done such a discussion at the time of conceptual framework. Okay. Let me just check if it's there in our notes. It will be there. Reporting entity. Somewhere should be there. I kind of remember. Yes, somewhere it is there. Okay. So you will have to take it as a financing arrangement. You will have to take it as a financing arrangement. So suppose you have entered into a contract to sell the goods for 1 lakh rupees and you buy it back for 1,10,000. This is a financing contract. You have taken a loan for 1 lakh. You are repaying it at 1,10,000. That extra 10,000 is your finance cost. So don't do into a sell contract and a purchase contract. Treat it as a loan arrangement. So that is one thing. The next one is I sell it for 1 lakh and I buy it back for 90,000. I buy it back for 90,000. Okay. So sale and 1 lakh I sell. Okay. 1 lakh. Seller, customer. Sale 1 lakh. Repurchase 1,10,000. This is a financing arrangement. Yet another case, seller to customer 1 lakh, customer to seller 90,000. Customer to seller 90,000. So this cannot be a financing arrangement because I will not collect less. So this is a usage arrangement, a lease arrangement. Okay, where the 10,000 rupees that we are paying it back, I mean the 10,000 rupees we are keeping and returning back 90,000 indicates that 90,000 is a security deposit, and that gap between 1 lakh and 90, which we are not refunding, that will be more like our lease charges. Okay, difference of 10,000 is lease rentals. Okay, is lease rentals. We had given them an option to use it. So they have used our machinery, etc., whatever we have transferred. Now we are taking it back. So therefore we are paying 90,000. Is it okay? Yes. So sale and repurchase में थोड़ा एक दो चीजें हैं, but I think you can do it off. So please try to do that later on. I will be coming straight away to service concession agreements. I will be coming straight away to service concession agreements because this is something which is not difficult, but rather वो थोड़ा क्या है, it's typical. And this is the last part of our standard for today. Then I will be sharing these notes over the next 2-3 days. Please download it and refer it. Please download it and refer it. And all the points, notes, whatever we have discussed over 5 days, everything will be captured in the presentation. So don't worry that sir has not given anything to write in the 5 days. Everything, whatever I have discussed word to word will be included in the presentation. You need not be worried about it. Okay. sale, repurchase, whatever small things which I feel you could do it by yourself, those also I will capture it in the presentation. So you won't have any feeling that anything got left out. Basically, the number of concepts are so huge in the standards, particularly the 100 series standards. 115 revenue, 116 leases, 103 business combination, 110 consolidation, 111 joint arrangements, and then you take 109 financial instruments. These 100 series are very comprehensively drafted standards. There are a lot of provisions. The Ind AS 1, 2, Ind AS 7, Ind AS 8, 10, all these, they are fairly, routine principles. Okay, the crux lies in the 100 series. The remaining are operational, related to assets, related to EPS, related to liabilities. Okay, so all these notes will be captured and shared with you. Don't worry. Now coming to service concession arrangements, this is appendix to Ind AS 115. Please pay attention. This is very important, and it appears to be tricky. It is not. It is not. Okay. इसको हम लोग बोलते हैं सर्विस कंसेशन अरेंजमेंट्स. Service concession arrangements. Now, what is a service concession arrangement? Example, construction of a toll road, construction of an airport, construction of a port, etc. Okay. Basically, a public-private partnership. A public-private partnership. Okay. What happens is, you have these companies like Adani, GMR, GVK Infra, Larsen and Toubro. All these entities are humongous entities with lot of resources. Okay, only they can do the job of constructing an airport. Do you think constructing an airport is a simple job? It starts right from land acquisition, land smoothing, then you have to construct the architects for where the departures will be there, where the runway will be there, where the entrance will be there, where will the check-in counters be there. Then you have to put a whole shopping mall in the airport. Duty free, you have to maintain security counters, aero bridges, buses, tarmac, everything is to be laid down. It's not an easy job. It's not an easy job. And therefore, what the government does is it comes out with tenders. We are planning to build an airport at such and such location. So please give your bids. And then these people will come and give their bids. Now, GVR builds an airport at Hyderabad. In Goa also, they have built an airport. Okay, I think it's GMR or GVK, whatever it is. Okay, I think in Goa it's GMR. GVK is there in Hyderabad. Bangalore, you have GVK. Okay. Tell me one thing. These airports, L&T builds a highway in some state or in some hilly area or in some hilly terrain. Adani constructs a port for the requirement of the government. Tell me, these assets which they are building, is it property, plant and equipment for the entity? Answer is no. It is the property, plant and equipment for the government. If it is an airport, the ownership of it is that of Airports Authority of India. If it is a port, then it will be the Port Trust. If it is your highways, then the ownership is with the National Highways Authority of India. So these assets are never going to be owned by these entities. So they have to put in their resources, their time, their costs, everything in great quantities to construct something that does not even belong to them. So to to compensate these entities for their efforts, the government comes out with two models. First one, entity has an unconditional right to receive cash. To receive cash. Okay. Now, unconditional right means what? Government gives assurance. Acha, assurance matlab kya? Assurance means you start collecting the toll, collect charges or toll from users and from government or both. But there is a guarantee. That you are going to get a defined sum of money. You are going to get a defined amount of cash. Unconditional right to receive cash. So a right to receive cash is nothing but a financial asset. Okay. So in these contracts, because the amount that the entity will receive is fixed, it becomes a financial asset for GMR or Adani or whatever it is, Larsen and Toubro. Okay. It becomes a financial asset. Alternatively, no unconditional right to receive fixed cash. Let us take an example of a highway. A very, what you can say, a very essential road that had to be constructed. That contract was awarded to Larsen and Toubro. L&T did the contract. Now, all the traffic goes on that road. The government knows that the importance of this road is strategic. It will yield revenue to the constructing entity beyond imagination. So the government tells, look, what we are constructing is one of the most essential roads that is required. The moment this construction is done, you will find all vehicles going on this only. And therefore, it becomes like an arterial road. And therefore, toll to aapko bhar ke milega. You are going to get crores and crores of rupees in toll money. So I am not guaranteeing anything. And toll money also, you only have a right to receive. But you don't know how much you will receive. But you don't know how much you are actually going to receive. And therefore, there is no right to receive fixed amount of cash. But there is a right to future economic benefit. Not fixed cash. Okay, it is a right to a future economic benefit, and therefore contract becomes an intangible asset. Kaise? First one, lacks physical substance. Sir, which intangible asset are you talking about? Your right, L&T's right to collect toll revenue is a contract that lacks physical substance, number one. Second, it is separately identifiable. There is a document that gives you this right. The government says, you construct, take 3 years, operate for 7 years. For 7 years, nobody can collect toll fees apart from you. So there is a separately identifiable intangible asset. And third one is, it is non-monetary in nature. Why do we say non-monetary? Monetary items means determinable amounts of cash. Non-monetary is not determinable amounts of cash, and therefore all these three conditions are fulfilling the definition of intangible assets. All these are fulfilling the definition of intangible assets. Are we clear with this? Both the contracts, are you aware of the distinction now? Yes or no? बोलो यार, दोनों में फर्क समझ रहा है? One contract, amount that will go to the constructing partner is guaranteed. Second case, guarantee नहीं है. Nothing is given. It's only given जो भी toll है, you will have to collect it. Only you have to collect it. You are exclusive to that. So now tell me, do you understand the difference between both? Have you understood the difference between both? Yes. So the first contract where right is established, it becomes a financial asset. Second case, it becomes an intangible asset. Accounting for this becomes slightly different. Accounting for this becomes slightly different. Let us understand with the help of an example. I hope my screen is visible. Okay. Construction contract is awarded to ABC Infrastructure Limited. You have obligation of construction. The cost of construction is 3,000. Margin expected is 10%. So standalone price is 3,300. And construction should be over in 3 years. Construction should be over in 3 years. Okay. Next, you have another obligation to operate and maintain it for a period of 7 years. Expected margin is 25% on an operating cost of 40. So therefore, standalone selling price is 50. This is per year. Revenue by the government. This is at the end of 10th year. It is 5,900. It is 5,900. So now, construction and operations and maintenance, these are two distinct obligations. These are two distinct obligations satisfied over a period of time. Why? Because you are carrying it on right from year 1, year 2, year 3, and then also satisfying. And then also satisfying. Are we clear with this? Yes. So both are distinct obligations satisfied over a period of time. Then what? You assess whether there is the 5-step model. Is there a contract? Yes. Do I have distinct obligations? Yes. Construction and operations. Is there a transaction price? Yes. Government has guaranteed 5,900 crores. Step number 4, allocating transaction price equal to based on cost plus expected margins, that is standalone selling price. Okay. And last one is recognize revenue by measuring progress, taking example a cost method. Okay, fine. Now, year 1, you have completed 800 crores. Year 2, 1,200 crores. Year 3, 1,000 crores. So this is the total what you have incurred. This is the total what you have incurred in years 1, 2, and 3. All right. Now let us start. Okay. In the first year, the cost incurred is 800. They have given to you. Construction cost incurred is 800. So the revenue will be 10% extra because of the the margin on construction. Yes. So 800 plus 10%. So that gives you 880. 880. Are we clear with this? Yes. 880. Next, year 2. 1,200 plus 10%, 1,320. Let us look at the loan amortization table. We started with 880 closing, then year 2, 880 plus 6.57% plus 1,320, 2,257. What is this 6.57? This is my IRR calculated. Okay. This working will be seen later on. Are we clear with that? Yes. Yes. Any doubts here? So every year you will accrue interest, and every year you will accrue the construction cost. You will accrue the construction cost. Yes. Is it fine? Anybody has any doubt so far? So every year 1100, 50, 50, 50, 50, 50, 50, 50. Yes. So you will be recognizing your additions, finance cost, closing in this particular manner, closing balance in this particular manner. Okay. And how do I get this 6.57%? Present value of cash inflows is equal to present value of cash outflows. When you equate both of them, your IRR can be calculated. Okay. So now all these are done. So construction cost to the P&L debit to bank, financial asset account debit to construction revenue. Then you have construction cost in the P&L debit, financial asset to construction revenue, and financial asset to finance revenue. So all these things are there. Yes. Year 3, year 4, the scheme becomes repetitive. At the end of year 10, your what you can say okay. Yes. So years 5 to 9, same set of entries. Year 10, operating cost, revenue, financial assets, and then whatever receivable is there, you add that to this and finish it off. Okay. So that takes care of a financial asset. That takes care if it were a financial asset. Are we clear with this? Yes. On the contrary, okay, so you can either receive the amount as a single payout at the end of 10 years, or you can receive in between the period. See, yearly 200 crores, end of the period 3,200 crores. Okay. So anything is fine. Even this is a financial asset. Because these are also defined amounts of cash that you are going to collect. And because these are defined amounts of cash, it becomes a financial instrument. Only thing is, in the loan amortization table, this is the new column that has been added. Are we clear with this? Yes. Are we clear? Yes. Okay, fine. And then the last one. Sir, what if it is an intangible asset? Amounts are not fixed. So what are you going to do? You have construction of the contract as an obligation, number one. Second one is you have operation and maintenance. And third one is you are having, that's it. So 2 obligations are there. Government has not granted any revenue. It's just a right to collect toll is given. So cost incurrence is 800, 1200 and 1000, same like earlier. Both are distinct. Okay. So these are our opening entries that we have passed. And finally, we have to check whether the 5-step model is satisfied or not. So what is the condition for satisfying? There is a contract, yes. Distinct obligations, yes. Transaction price, fair value of intangible asset received. Barber giving construction services, receiving right to collect toll. Fair value the right, that is the intangible asset as per Ind AS 38. Yes. Cost of construction cannot be considered value of intangible asset, because what you are getting is an intangible asset. You are not getting a defined right in cash. Okay. So what are the journal entries that we are going to pass here? Year 1, construction to bank, straightforward. Intangible asset to construction revenue account. So now here you go on starting recognizing the intangible asset. You go on recognizing the intangible asset. So 1120. Then the next one is construction cost to bank for 1200 rupees, 1680. And finally 1000 for 1400. So once this is done along with this 4th year, each year what are you going to do? Each year what are you going to do? You are going to amortize the intangible asset, number 1. You are going to maintain, for which you will incur cost. You are going to collect those costs from there, for which again you may have to raise an invoice. Yes, so there, that is how you are going to do this. Okay, so this is what you are going to do. Here you don't have an amortization table to be created. Why? Because financial asset is not there only. This becomes an intangible asset. So intangible assets are not amortized. They are taken quite in the normal way. So the moment the intangible asset gets ready after 3 years, you will have to amortize it over the next 7 years. Over the next 7 years. Are we clear with this? Yes. Are we clear? So this takes care of service concession contracts. We have 2 questions. This is an year-wise, very detailed and thorough question. Okay. This is an year-wise, very detailed and thorough questions which we have done. The institute's question that you are having on the Jabalpur-Bhilwara highway, as well as, one second, let me open. Illustration 75 is a very basic illustration. They have not asked month-wise entries. They have asked whole contract-wise entries, which I'm sure you can do this. Okay, so this one question also I'm going to share it with you, question as well as the answer. Okay, so service concession arrangements is done. Did you understand those questions, that small question that we did in the Excel file? Yes. Have you understood that? The intangible asset part, the financial asset part, are you able to follow? Yes. Panchika has confirmed. Yes. What about the others? Did you follow, guys? Yes. I hope you followed. Okay. So with that, we are done. At least 90% of the topic I have been able to cover in the last 5 sessions. Questions I would have loved to solve. I would have loved to take your RTP and your past exam questions, but you saw the content of the standard. It's huge. See, in spite of spending close to 3 hours, and on Saturdays and Sundays, we spent 4 hours. In spite of doing that, we could not complete all the topics, but yeah, 90 to 95% is done. So the coverage as such is over. You will have to put in extra efforts and read up whatever is left out, small topics. So pad lena. I will see if we can get a problem solving session with all of you on one of the weekends. I will request the institute. So if we get a problem solving session only, then what I can expect you is you can come with the standard prepared. We will revise the related, we will see the question, understand what concept is there, revise that concept, do the question, proceed further. Only problem solving, no standard discussing. Okay, so that way I think you could be more comfortable for the examination. Let us see. If we have a problem solving session, I will definitely be a part of it. Okay, so with that we conclude our discussions for today. See you guys. You don't have my next session this month. I think we will be meeting next month only. Okay, we'll be meeting next month. If you have any issues, please let me know. Please let us know where we can improve, where we can do better. At the same time, don't stop interacting with faculties. It makes a huge difference, a positive impression. It keeps the faculty alert. Okay, you guys have been really great. Thank you for the patient hearing over the 5 sessions, and look forward to seeing you on in November, hopefully, with another set of standards. Okay. All right. So anybody has anything else to say? Yes. Yes. We'll be missing you, and we'll see. We'll catch up in November. Okay. We'll catch up. For anything, feel free to write. Feel free to write to the institute, fr-final@icai.in. Okay, fr-final@icai.in. So please go through this, and you can understand. Is it okay? Fine. So that's it. Thank you, everyone. Thank you, and have a good day. Yes, yes.